Entering the financial services industry as a stockbroking firm in 1990, today Capital Trust Holdings has expanded into many areas of businesses, including investment advisory, margin trading, wealth management, development of luxury apartments, property brokering and property management, information technology, automobiles and education, to become one of Sri Lanka's leading business organizations. Capital Trust Properties has ventured into the real estate sector with the acquiring of a large number of unique properties in Colombo and its suburbs. In its investment portfolio are a 5-storied building in Union Place, Colombo 2, a 7-storied building in Duplication Road, Colombo 3, a 7-story building in Glennie Street, Colombo 2, and 40 other properties. Capital Trust Properties has also partnered with reputed global brands to promote real estate in Sri Lanka and abroad with liaisons of Nye, Frank and Avon Group Limited.
Good morning, ladies and gentlemen. On behalf of Capital Trust Research Private Limited, it gives me immense pleasure to welcome you to our research webinar on the export sector picks. Capital Trust Securities is ranked number 1 for the first quarter of present financial year in terms of transaction turnover and brokerage turnover. It possesses probably the largest local client base in the Colombo Stock Exchange. Today's webinar is the 9th of a continuous series of webinars that Capital Trust Holdings Group will be conducting on listed sectors, the macroeconomy, market outlook, technical analysis, and real estate. Today's webinar on export sector stock picks part 2, key takeaways will be advantage of investing in export-focused companies in an LKR depreciating environment, our preferred stock picks in the export sector that should outperform the market, Expolanka Holdings PLC and Teejay Lanka PLC, key catalyst of growth for selected stocks, recommendations, earnings projections, valuations, and target prices. Capital Trust Research Private Limited has been in the forefront in correctly identifying and recommending stocks that have generated significant outperformance during pandemic conditions as a result of the continuous LKR depreciation and import restrictions. It has guided its clients to make enormous returns and kept the Colombo Stock Exchange very active. Now we are pleased to introduce Mr. 𝗞𝗲𝗶𝗵𝗵𝗵𝗵𝗵𝗁, Head of Research of Capital Trust Research Private Limited, and Mrs. 𝗞𝗲𝗶𝗵𝗵𝗵𝗵𝗁, Head of Corporate Finance of Capital Trust Partners Private Limited, who will make the presentations. We will be happy to answer those questions you may have at the Q&A session. Thank you.
Thanks, Prashani, for the introduction, and good morning, everyone. As mentioned to you a couple of weeks back, Capital Trust Research has been right throughout advising clients to be ready for continuous LKR depreciation. The Sri Lankan rupee has witnessed a depreciation of 7% year to date, and we expect this to aggravate further in the coming months. In order to benefit in this economic environment, we have always advised our clients that investments in companies with foreign currency revenue streams and foreign currency assets will provide strong total returns. At our previous webinar, we explained how dip products, Haley's Fabric and 𝗶𝗶𝗆, are well positioned to record strong earnings and also further benefiting through LKR depreciation. Today, we would like to brief you on why we feel Expolanka and Teejay Lanka are well positioned to record strong earnings growth and increase market share in their respective industries. Let's start with Expolanka. As I'm sure you all know, Expo's business segments consist of logistics, leisure, and investments. The logistics segment contributes 98% of revenue. EFL is Expo Group's logistics arm, which started out as a freight forwarding service provider and now has evolved into a truly global multinational company. Currently, in the logistics sector, the company has 60+ offices, employing more than 2,400 people and across 29 countries. The company offers connectivity across all key international trade routes. EXPO'S Japanese-based parent, SG Holdings Global Private Limited, operates in delivery, logistics, real estate sectors, and has a vision of becoming Asia's leading comprehensive logistics group. As you can see on the chart on the left, EXPO'S US subsidiary accounts for 63% of EXPO'S total revenue in FY21, compared to just 34% in FY20, while the US trade lane accounts for 75% of total revenue across all its subsidiaries. Since the conclusion of the legal proceedings associated with EFL's US operation in FY20, EFL USA has grown from strength to strength by consolidating its position in apparel logistics, as well as successfully positioning itself in new verticals such as technology, automotive, e-commerce, perishables, and home improvement logistics, as well as offering various logistics solutions for PPEs during the pandemic. Given EXPO'S exposure to the US economy and the contribution of its US subsidiary, we can classify EXPO as a US-centric multinational and a true global brand. As I mentioned before, EXPO is heavily exposed to the US economy and its performance. Hence, it's important that we analyze the future outlook of the US economy as well. As per the latest IMF projections released in June 2021, the real GDP growth for the US for the year 2021 was revised up from 6.4% to 7%. And for 2022, growth was revised from 3.5% to 4.9%. The reasons for this upward revision are strong aggregate demand, and it has resulted in sharply falling inventories. This will add to growth as firms replenished inventories during the second half of 2021. Moreover, the relaxation of pandemic restrictions has accelerated as the vaccinated share of the population continues to rise. This resulted in pent-up demand as employment and disposable income picked up and fuels economic activities. We expect US GDP to surpass its previous peak in the second quarter of this year, as well as unemployment rates to decline to 3.5% by late 2022, which will result in strong economic performance and trade volumes in FY22 and FY23. Canada is also an important market for EXPO, similar to the US. The Canadian economy is bouncing back, with Canada's real GDP is forecast to grow at 5% in 2021 and 4.6% in 2022. US import trade is running 4.7% above the pre-pandemic 2019 figures and 36.4% ahead of pandemic-affected 2020 totals over the months of April to May, as per the latest figures released by the US Census Agency. Exports are also performing well compared to 2020, up 38.7% over April-May months of 2020, but marginally down 3.2% over April-May 2019. China finished 2020 as the nation's top trade partner and tends to increase its trade in the second half of the year. It is interesting to note Vietnam increased its trade with the US by 45.82% during the Chinese-US trade ban imposed during 2020. Vietnam ranks 8th among US trade partners, up 5 places from 2020. Given EXPO'S presence and focus in the Far East, in the main countries of origin for US trade such as China, Vietnam, Cambodia, and Indonesia, which are in the top trading nations with the US, we expect EXPO to consolidate its position in these countries by offering new verticals and acquiring new strategic customers by offering reliable and competitive logistics services. Let's now move on to looking at current ocean freight rates that have reached an all-time high due to multiple reasons. Container shortages, shipping capacity constraints, port congestion, and blistering global stimulus-fed demand for goods has resulted in the cost of shipping those goods from Asia to Western countries to increase to new highs. Average port-to-port rates from Shanghai to Los Angeles on the West Coast have soared from $1,500 per 40-foot containers in early 2020 to $4,000 in September 2020 to $8,000 in June 2021, and increased further to $9,631 in the week ended July 8th, according to Brewery Supply Chain Advisors. This would be an increase of over 500% from early 2020. But as per industry sources, there are reports of rates quoted at even at $15,000 from China to the West Coast to prioritize the loading of late bookings ahead of normal freight all kinds rate cargoes. This would be a tenfold increase from early 2020. On the East Coast of the US, freight rates from Shanghai to New York have soared 39% to $11,180, which is more than 3 times the rate last year. One of the main reasons for the rise in ocean rates is due to the port congestion in one of China's busiest ports in Yantian due to the COVID outbreak. These disruptions are causing an extremely tight space situation in cargo to the US. This might result in rates increasing further in the month of July. Moving on to air freight. Supply chain conditions and economic activity are supportive of air cargo, helping it post its 5th consecutive month of overperformance versus global goods trade. Air cargo capacity continues to slowly improve despite the lack of international passenger traffic. Having said that, market remains tight with no clear decline in cargo load factors. Currently, air cargo benefits from exceptionally congested container supply chains. Global shipping schedule delays rose significantly and congestion increased as explained earlier. A consequence of this is that the price of air cargo relative to that of container shipping has fallen significantly. Air cargo was more than 12 times more expensive than ocean shipping prior to the pandemic. But this has fallen to a ratio of 6 in May 2021. This adds to the competitive advantage of air cargo. FreightOS.com marketplace data showed Asia-US air freight rates climbing about 25% to most destinations in April and remained elevated through May. While rates came down about 5% in the recent past, Asia-US lanes prices are still up 3 times higher than a typical year. Expectations are that air cargo peak season falls normally in October and November, but this year it could start in September with importers rushing to make sure that holiday inventories arrive in time. In addition, COVID-19 outbreaks prompted officials at some origins to impose regional lockdowns. This is impacting factory output and volumes flowing to airports. These tight conditions are likely to keep rates elevated for some time. Air cargo continued to perform well in April and May 2021 as industry-wide cargo ton kilometers or KTKs rose by 11.3% and 9.4% respectively compared to pre-crisis levels in April and May 2019. The airlines in all regions but Latin America contributed positively to the headline growth rate of 9.4% in May 2021. Once again, North American airlines supplied the most at 4.6%. During FY21, the logistics segment recorded exceptional revenue growth of 119.2%. This was driven by air freight operations amidst elevated freights and increasing number of charter flights across various verticals. Revenues were supported by pickup of US trade volumes during the second half of FY21 as well. Segment profitability was driven by higher yields on core business volumes and PPE shipments. Air freight contributed 77% to logistic gross profit during FY21. This was supported by increased yields even though volumes declined to 189 million kilos from 206 million kilos during 2020. Ocean freight volumes though grew to 255,000 TEUs in FY21 in comparison to 220,000 TEUs in FY20. Proactive yield management strategies resulted in maintaining gross profit margins at 17.5%. Operating margins grew to 8.3% in FY21 compared to 2.5% in FY20. It is important to note that Expo and SG Holdings have a strong bargaining power and strategic relationships with the network of carrier partners. Therefore, even with the tight capacity constraints, Expo has the ability to secure ocean and air freight space at competitive pricing in advance. Therefore, they are able to offer capacity efficient pricing to its strategic buyers, which fuels further demand for its services. Given Expo's present in the Far East as well as the subcontinent, which are the US's main trading partners, the company can offer end-to-end solutions to strategic clients across all operating markets and facilitate trade into the US. For example, in terms of apparel logistics, given Expo's presence in main origin markets such as Sri Lanka, Bangladesh, China, Vietnam, Cambodia, etc., they can provide end-to-end solutions to strategic customers such as Nike across markets. Based on the presence in key origin markets, the company expects to increase its wallet share across key strategic clients, which will further drive volumes in the future. Expo's dynamic management have also taken a decision to consolidate its position in these origin markets by hiring the most experienced and capable personnel that will enable the Asian-based subsidiaries replicate the resounding success it achieved in the US by following the same strategy. In addition, as per management, the company is looking to acquire new strategic clients and consolidate itself in key origin markets by exploring mergers and acquisition opportunities. The V-shaped economic recovery in the North American markets, as explained earlier, is expected to result in strong volume growth in FY22 and FY23. Expo is well entrenched in the EU markets as well, with operations in Denmark and Belgium. With the EU economy also expected to recover in the fourth quarter of FY22 and FY23, Expo is in prime position to take advantage of the same and increase its sales. Since the end of 2021, the company has seen an increase in sea freight volumes, given its ability to secure space in its current operating environment. The strong relationships established with carrier partners are expected to continue driving volume in the ocean freight space. Expo's global logistics operation recorded outstanding results during FY21. This was supported by growth in the North American trade lanes. As discussed earlier, freight rates across ocean and air continues to remain high, and volume growth is too expected in FY22 and FY23 as the US economic recovery gathers pace. With the ability to leverage off its parent SG Holdings, Expo usually block purchases the air freight and ocean freight space in advance at competitive pricing. Therefore, when freight rates increase, their yields and profitability also increases. Moving on to the logistics sector, strategy and outlook, we have highlighted a few key areas that we would like to touch upon. Let's start with the broadening its regional footprint. As mentioned previously, the company is focused on strengthening its network operations in key origin markets in Asia, as well as exploring new markets. The key origin markets for the company in the Far East are Vietnam, Indonesia, China, and Cambodia, which are all key trading markets with the US. The new markets the company is focusing on at present is Malaysia and Thailand, where operations commenced in the last financial year. The company also set up new operations in Denmark and Belgium to take advantage of opportunities in the EU. With setting up in these key markets, the company has been able to increase the number of strategic customers from 10 to over 50 over the last few years. Given the company's strategy to broad-based carrier partnerships across markets, they are able to source capacity and provide total logistic solutions to all its key strategic clients, even under tight operating environments. By providing such solutions to strategic customer portfolio, the company expects to increase its growth in wallet share in the future. Although the apparel sector continues to be Expo's core segment, it is also aggressively consolidating its market share across following verticals. Let's start off with technology. Vietnam and China are considered hubs for electronic and technology manufacturing. Given Expo's present in such origin markets, it has aggressively grown its market share in the technology space by adding companies such as HP to its strategic customer portfolio. Please note that the technology vertical is the company's second largest vertical in terms of revenue contribution at the moment. In addition to the above, the company has also focused on establishing its client base across verticals such as automotive, perishables, and home improvement segments. As explained previously, the company is exploring the possibility of expanding its reach in the Far East and US markets while looking at mergers and acquisition opportunities. I'm sure you remember Expo recently acquired a company in the US to provide bonded trucking and bonded container freight station services. This is a strategic investment to enter the vast domestic logistics space in the US. This enables a company to be a service provider to strategic clients by providing end-to-end logistics services, not just freight forwarding. With regards to the organic growth strategies, the company successfully achieved exponential growth in the US by hiring the best of the best industry personnel with proven experience. Now the company is replicating the same by hiring the best talent in the Far East origin markets as well to achieve similar results. Finally, given Expo is the market leader in 3PL logistics in Sri Lanka, and given the country's strategic positioning, Expo is looking to expand operations in Sri Lanka as well. Over the last 3 years, the company has continued to focus on digitalization across the business to achieve operating efficiencies and improve operating margins. The company has focused on technology to enhance transparency, improve service capabilities, as well as improve customer experience and generate internal operational efficiencies, which ultimately boosts bottom line. Classic Travel represents Expo's group's leisure cluster. The sector experienced 75% reduction in revenue and a 382% reduction in EBIT during FY21. Management have made a call to restructure the segment by preparing for future opportunities by focusing on corporate and experiential travel, achieving operational efficiencies and putting in place lean structures with the aim of turning profitable in FY23. The comprehensive suite of offerings, along with the proven track record, will be the key differentiators in positioning Classic Travel as the country's premier experiential travel solutions provider. Moving on to the investment sector, revenue declined 32% in FY21, while EBIT increased by 10.92 times. Export and trading operations recorded lower volumes, while margins were impacted owing to high freight rates. Within the company's IT sector, ITX 360 operates a fully fledged integrated IT solutions provider, offering a range of IT services, including IT infrastructure development services and technology solutions for logistics companies, to name a few. Given the market demand and scope of its product offering, management had transformed the entity to a fully fledged independent solutions provider. Having looked at the current operating environment of the ocean and air freight segments, as well as analyzing the Expo's value propositions, let's move on to looking at what we expect in terms of financial projections over FY22 and FY23, which I'm sure is what you all tuned in for. Let's start with our expectation of revenue. During FY21, the total revenue recorded exceptional growth at 111.8%, As discussed before, given the increased freight rates across air and ocean segments, we expect Expo to maximize its yield in FY22 and 23. We also expect Expo to handle high volumes of ocean and air freight, given the expected economic recovery in key markets such as the US, Vietnam, EU, as well as other customer acquisitions across new vertical offerings. Thus, we forecast Expo to record revenues of 306.46 billion and 383.87 billion in FY22 and FY23 respectively. This reflects a growth of 40.1% in FY22 and 25.3% in FY23. Expo's success across key markets and key verticals, as well as its ability to offset competitive pricing, is expected to result in a boost to earnings during FY22. EBIT margin for the logistics sector in the first 3 quarters of FY22 is expected to be strong at 9.5%, given the ongoing capacity constraints. The increase in demand and lack of supply has resulted in higher rates and better yields for the company. However, given the passenger capacity could see a pickup in the 4th quarter of FY22 and easing of supply constraints, freight rates may gradually normalize. Thereby, we expect EBIT margins to be lower at 9% in the 4th quarter of FY22. We conservatively forecast EBIT margins to decline to 7.5% in FY23 once freight rates normalize. Given the 3rd wave of the COVID-19 outbreak limiting outbound and inbound travel into Sri Lanka in FY22, the leisure segment continues to realigning its operations and limiting losses. The leisure sector plans to prepare for future opportunities as explained earlier. The investment arm is expected to narrow down its losses following the recovery in exports markets and further supported by the development of its IT solutions provider, ITX 360. As a result of the strain from the leisure and investment sectors, the EBIT margins at a consolidated level are forecasted at 8.9% and 6.6% in FY22 and FY23 respectively. The group's net profit to equity holders is expected to reach 22.74 billion in FY23, growing at 53.3%, owing to strong margins in the logistics sector. In FY23, we expect net profit to conservatively grow at 3.86% to 23.61 billion. We conservatively assume EBIT margins will ease in FY23. This is owing to declining yields as demand and supply imbalances normalize going forward. Saying that, given the exponential growth in volumes from the US and the EU markets forecasted, we expect moderate growth in PAT in FY23, even though yields decrease. So let's summarize. We expect the company to report an all-time high profitability of north of 6 billion in the 1st quarter of FY22, and an astounding 22.74 billion in FY22. But what is very important to note is that these earnings are actually sustainable and not one-off. We are actually conservatively expecting moderate growth in PAT in FY23, even after yields normalize. Moving on to the valuation, Expo is valued attractively at 4.69 times FY22 earnings and 4.51 times FY23 earnings. This is a discount of 56.41% and 58.04% respectively to the broader market PERs of 10.76 as per the current CSE market data. This results in a fair value of 125.1 rupees per share based on FY22 earnings. Given Expo is a globally established logistics-focused MNC, with exposure to a diverse sources of foreign currency and assets, with 93% of its revenue in foreign currency, the counter provides a natural hedge for investors against LKR depreciation. it also provides an opportunity for Sri Lankan investors to be exposed to the US economy in terms of investments and asset diversification. Having looked at Expo's peers in the current operating environment, they are trading at an average of a forward PE of 19.9 times. We assume the PE of 10.76 times for Expo, in line with the broader market of the CSE, which is a 45.92% discount to its peers. The current trading multiples for the counter are low, as we mentioned earlier, as the general market sentiment was that in FY21 earnings were one-off and were expected to come off in FY22 and 23 post-pandemic. But as I just mentioned, this isn't the case. We are confident that FY22 and FY23 earnings will significantly surpass FY21 earnings. And we would also like to reiterate that if yields normalize, the exponential growth in volumes forecasted over FY22 and FY23 will offset the declining yields and enable the company to achieve moderate growth in PAT in FY23. Given the expected dividend payout of 22% on a free cash flow basis, we expect Expo to record dividend yields of 4.69% and 4.87% in FY22 and FY23 respectively. That ends our initial brief on Expo. Now I will hand over to Divya to discuss TJL.
Thanks, Hasita, for your insights on Expolanka. Moving on to the next talk, we believe that Teejay Lanka is well positioned to record strong earnings growth, supported by the planned additional capacity enhancements, high capacity utilization levels, and growth in strategic accounts. The company will further benefit from the LKR depreciation. Teejay Lanka is considered the largest textile group and knit fabric manufacturer in South Asia. The company has manufacturing facilities in Sri Lanka and India. It is the only multinational textile mill among the fabric mills in Sri Lanka. TJL is backed by industry giants Brandix Lanka, Sri Lanka's largest apparel exporter, who has a 32.74% shareholding in the company, and Hong Kong-listed Pacific Texture Jersey Holdings, the world's second largest textile mill with a 27.62% shareholding. The group's manufacturing facilities in Sri Lanka has a capacity of 40 tons per day and is located within the Seetawaka export processing zone. The Indian facility has a capacity of 35 tons per day and is located within the Brandix India apparel city in Visakhapatnam. The group also has its own printing plant, Teejay Lanka Prints. TJL differentiates itself from its competitors as a specialized, high-end cotton fabric manufacturer. The company has also established its position in the synthetic fabric market. TJL Group plans to increase its capacity by 25%. These additions will primarily be installed at the Indian facility. 20% of this enhancement is expected to be in effect in the fourth quarter of financial year 22, with the balance coming in the first quarter of financial year 23. The company is also exploring opportunities in Bangladesh and Africa, and may enter destinations based on end client and vendor partner requirements. TJL works with 8 key strategic, globally renowned fashion brands. The company has been successful in converting US-based Nike and Japan-based Uniqlo to being key strategic customers within a short time frame. Other key strategic brands within its customer portfolio include PVH, Limited Brands, Marks & Spencer, Calzedonia Group brands Intimissimi and Tezenis brand, Lidl, and Decathlon. These brands contribute to 80 to 90% of the revenue. Given the increased demand from strategic brands and in order to support their growth plans, TJL plans to increase its capacity by 25%. These additions will primarily be installed at the Indian factory, of which 20% of the capacity will come into effect in the fourth quarter of this year, with the balance in financial year 23. The company has started outsourcing some of the orders owing to the increased demand from these strategic accounts. TJL's core segment, weft knitted fabric, is expected to see increased demand and significant growth due to lifestyle changes led by the pandemic. This segment consists of men's and women's undergarments, foundation garments, loungewear, t-shirts, and yoga pants. Smart clothing and synthetics are growth segments for TJL, which could result in higher margins. Woven, which is generally more formal, has seen a reduction given the change in lifestyle owing to the pandemic. TJL differentiates itself from its competitors as a specialized high-end cotton fabric manufacturer. The company has created a competitive advantage through value addition and strategic partnerships. Cotton accounts for 90% of their product mix. The company has also established its position in the synthetic fabrics market. Its product mix within synthetics is tilted towards nylon, which generates relatively high margins. As evident in the pie chart, approximately 20 to 30% of revenue is generated from the basic segment, while the mid-range accounts for 40% and the premium range accounts for 30 to 40% of the revenue. Going forward, TJL will increasingly focus on improving contribution from the mid to high-end products. TJL has set up a development team trained by an international R&D expert to develop value-added ranges. The company focuses on innovation and development of sustainable products. TJ is committed to making ongoing investments in technology and modernization of plants to create a sustainable business model. Innovation is an integral part of the company's focus and helps the group to develop a better product mix. The company's focus is on creating a range of products, including high-end, high-performance fabric using different yarns, dyes, and chemical processes such as botanical dyed, amnisel, and naturol. TJL launched the world's first carbon-neutral fabric in financial year 17. The group also ventured into lace manufacturing in financial year 20 by strategically collaborating with Luanfeng Textiles in China. The group introduced a breakthrough innovation used for activewear, dry chilled cotton, which dries 3 times faster than any other fabric. This is used by some leading global brands. TJ is constantly exploring new horizons in sustainable product development, including recycled, biodegradable, and bio-based raw materials. It has also been in the forefront of devising water and energy-efficient products made with special fibers. TJL collaborated with a Brazilian research institute to recycle the salt water used for dyeing fabric and reduce the water usage by 60%. The group has also undertaken thermoregulating, super stretch, and high power fabric ranges in the performance category. Multiple value-added products with wellness attributes were manufactured, while reactive print fabric was also added to the product portfolio. In addition, it has developed a post-COVID fabric collection, which focuses on defensive fabrics such as antiviral, antimicrobial defenses, textiles with carbon compounds, and a sustainable fabric collection. TJL is the first Sri Lankan company to join the US Cotton Trust Protocol in July 2012. This program sets a new standard for more sustainably grown cotton. This further affirms TJL's commitment to use sustainably and ethically produced raw materials and provide transparency throughout its supply chain. As reflected in the chart, the revenue contribution from new sustainable products amounts to 60%. The company has been continuously introducing new products, with 78 new products being approved in financial year 2021. New product realization has been significant at over 40%. Sri Lanka's apparel exports grew by 33.67% year-on-year for the period of 5 months from January to May 2021. This was led by the EU recording a 44% growth year-on-year and US market recording a 21.29% growth year-on-year. Sri Lanka's largest apparel export market is EU, with 44% contribution in Jan to May 2021, followed by US with 41% contribution and other markets contributing 10%. Within the EU market, approximately 60% of exports qualify for preferential access due to EU GSP plus tax concessions. Exports to the EU grew at 4.5% CAGR from 2017 to 2019 after regaining GSP plus, compared to a CAGR of 2.3% in 2010 to 2016, where GSP plus was withdrawn from Sri Lanka. In the recent past, there have been calls to discontinue the GSP plus concessions to Sri Lanka. However, we believe that the withdrawal is unlikely. And the government is in the process of taking the necessary steps to amend the Prevention of Terrorism Act and abide by other conditions imposed. Although the impact from a removal of GSP Plus will affect the apparel sector to some extent, we expect no impact on TJL. The reason being, the fabric manufactured by TJL is not directly exported to the EU as such. It is just a raw material used by apparel manufacturers. It is mainly the finished garments that qualify for GSP Plus. Management of industry-leading players such as MAS claimed that of their exports to the EU, only 5% of the exports actually claimed the GSP Plus tax concessions. TJL generates 51% of revenue from EU-based brands. The revenue mix for the company was largely unaffected pre- and post-GSP Plus. Revenue grew at 15.58% CAGR in financial year 11 through to 17, even after losing the GSP Plus. This signals TJL's ability to withstand challenges arising from a potential loss of GSP Plus. We believe that there will be no impact to TJL in the absence of GSP Plus, as TJL caters to more strategic brands which require high-end fabrics rather than a price-driven segment. TJL has built strategic relationships with key buyers by investing in research and development and ensuring sustainability and environmental KPIs are met. This is important for various Tier 1 brands, as customers are now very conscious of products being produced in a sustainable and eco-friendly manner. Therefore, majority of the company's revenue is not price sensitive. Further, any adverse impact can be mitigated by moving orders across its manufacturing locations in Sri Lanka and India, benefiting from its regional footprint. TJL is also expected to benefit from certain key buyers further enhancing their footprint in Sri Lanka. In any case, the government has informed the EU that they are in the process of reviewing and amending the PTA in line with the promises made to the EU in 2017, as well as ensuring basic human rights of all citizens are protected. Therefore, we believe that GSP Plus will not be revoked. When looking at the graph, it is evident that TJL has been continuously outperforming its local peers, recording strong revenue growth. The company has recorded a revenue CAGR of 14.55% over the last 3 years. Following the pandemic, retailers are focused on moving away from single destination sourcing. Also, the US-China trade war and the Xinjiang cotton ban has resulted in a major shift with retailers preferring alternate manufacturing centers such as Sri Lanka, India, Bangladesh, Africa, and Dominican Republic, which will positively drive TJL volumes going forward. Further, the company is well positioned to capture the opportunities arising from the demand and supply gap in the synthetics market, as reflected in the chart. The local apparel industry imports approximately $630 million of synthetic textiles annually versus a domestic production of $50 million. TJL is well positioned to benefit from increased demand in synthetics. Further, the new capacity additions made by the company consist of dual-capable machinery. This provides flexibility to produce both cotton and nylon products, which will enable the company to cater to the demand-supply mismatch in the synthetic fabric requirement. Moving on to the financials. TJL recorded a strong revenue growth reflected in a CAGR of 18.7% from financial year 15 through to 20. During this period, TJL inorganically expanded through the acquisition of an Indian knit manufacturing plant, Ocean India, in September 2015 for $15 million. The group value chain was also strengthened via its investment in a printing facility, Teejay Lanka Prints, formerly known as 𝗞𝗲𝗏𝗵𝗵𝗵𝗵𝗁 in June 2015 for $3.5 million. Indian operations were further strengthened by doubling capacity of Ocean India's capacity in financial year 18. Revenue dipped 4.28% year-on-year in financial year 21, mainly led by the adverse impact to the orders from the pandemic in the first quarter. TJL increased its capacity by 5 tons per day to 75 tons, of which the full benefit is to materialize through increased capacity utilization in financial year 22. Considering the planned capacity enhancement, strong order book, and high capacity utilization, we expect strong revenue growth of 32.48% year-on-year in financial year 22, resulting in a revenue of 42.2 billion rupees. In financial year 23, revenue is expected to see the benefit of added capacity, resulting in a 15.54% growth year-on-year, with revenue recorded at 4.8 billion rupees. A significant improvement in the average selling prices is also expected in the second quarter, owing to an increase in key raw materials, yarn prices of synthetic and cotton. TJL is also expected to benefit from its revenue being in foreign currency, considering the Sri Lankan rupee and Indian rupee depreciation against the dollar. Group capacity is expected to be further enhanced by 25% through an investment of approximately $26 million. The expansion is expected to be funded via a mix of debt and equity. Our forecast assumes that 20% of the planned increase will come into effect in the fourth quarter of financial year 22, and the balance coming through in the first quarter of financial year 23. Group capacity is expected to be at 93.75 tons per day following this capacity addition in India. This expansion is to mainly cater to the requirement of strategic brands, including Nike and Uniqlo. The company will also work with some of the larger Indian domestic brands going forward. The company outsourced some orders to third parties in financial year 21 in order to build momentum and gear up to cater to the expected increase in production. Next up, looking at the composition of GP margins, 65% of the cost of sales is accounted for by raw materials, dyes, and chemicals. As depicted in the graph, cotton prices and oil prices generally move in tandem, as the synthetic fibers are made from petroleum polymers. There is an inverse relationship between GP margins and input costs, owing to the inability to pass on entire cost increases to the end clients. TJL minimizes the impact to margins amid fluctuating cotton prices by its strong focus on increasing premium product revenue, thereby enabling them to pass on the cost escalations to the end client. Further, TJL's main energy source consists of coal power and solar power. TJ India has also generated steam using multi-fuel boiler while using paddy husks as an energy source instead of coal or furnace oil. The company is able to optimally manage its energy costs, which accounts for approximately 8% of cost of sales. The company has seen significant capital expenditure over the years. This includes organic and inorganic capacity additions and machinery improvements. Efficiencies were increased by 10 to 20% in financial year 20 by investing 1.4 billion rupees in modernizing its plant with the state-of-the-art machinery. The company has largely maintained its gross profit margins over the last 4 years, averaging at 11.99%. However, a decline was witnessed from 12.71% in financial year 20 to 11.82% in financial year 21, owing to the pandemic-related impact experienced in the first quarter, where GPMs fell to 5.41%. Since then, however, gross profit margins have recovered, with 15.02% recorded in the third quarter of financial year 21. In the fourth quarter, gross profit margins declined to 11.77%, owing to the rise in raw material prices and the time lag associated with passing on cost increases to the end client. TJL is able to pass on cost increases to the end client for value-added fabric. However, for the basic core products, the company will be able to pass on only a portion of this cost increase. We have forecasted gross profit margins at 11.65% in financial year 22, owing to the increase in raw material prices and outsourcing orders to build momentum for the capacity increase. Gross profit margin is conservatively forecasted to return to its historic average in financial year 23 at 11.95%, led by strong demand and high utilization levels. Looking at the chart, it is evident that TJL has consistently recorded the highest EBIT margin among listed industry players due to efficient cost management strategies. A marginal decline in EBIT margins from 8.2% to 7.81% was witnessed in financial year 21. This is primarily owing to the pandemic-related impact experienced in the first quarter. Going forward, we expect EBIT margins to continue to remain healthy at 8.26% in financial year 22 and 8.78% in financial year 23. We expect steady EBIT margins and EBIT growth of 40.11% year-on-year in financial year 22 and 22.83% year-on-year in financial year 23, mainly led by strong top-line growth. TJL is well positioned to record strong earnings over the next 2 years, with installed capacity increasing by 18.75 tons through the capacity additions in India. The increased capacity will enable the company to support growth of its key strategic brands. To build momentum, the company has already geared up to cater to the growing demands of strategic accounts. We expect capacity utilization to be at high levels at 80%, even after the capacity additions are in place. TJL is also the only local fabric mill with a regional footprint. Given its presence in India and Sri Lanka, the company has the flexibility to shift between manufacturing locations, diversifying any risks that could arise in one geography. The company has shown resilience in the past and is expected to not have any impact in the unlikely event of a loss in GSP+. Innovation being at its core, TJL will continue to be ahead of the curve and be able to retain and expand key strategic accounts through offering of premium range products and new sustainable range products. The company is a beneficiary of the Sri Lankan and Indian rupee depreciation against the US dollar. TJL is also backed by leading industry players, including Brandix Lanka and Hong Kong-listed Pacific Texture Jersey Holdings. Moving on to the valuations, TJL is currently undervalued, trading at 8.85 times FY23 earnings. we assign a target price of 50 rupees and 10 cents based on a price to earnings multiple of 10.76 times on financial year 23 estimated earnings, providing an upside of 21.6%. The PER valuation multiple has been arrived at considering the market PER and the comparable export-oriented company PERs. The company trades at a premium to its local peer MGT, which is currently trading at a PER of 12.09 times on a trailing 12-month basis. This premium is justified given the sheer size of the facility, its regional footprint, operational efficiencies, and ongoing innovations undertaken by the company, enabling them to be ahead of the curve. We expect net profit attributable to equity holders to grow by 30.26% year-on-year in financial year 22 to 2.79 billion rupees, and by 19.7% year-on-year in financial year 23 to 3.34 billion rupees, led by strong revenue growth. The capacity increase to support the key strategic brands, Nike and Uniqlo, in financial year 22 and 23, and growth in some of the larger Indian domestic brands, along with the average selling price increases to support higher raw material costs, are expected to be key pillars of growth. TJL gathered significant investor interest following its regional expansion in financial year 16 and doubling capacity at its Indian plant in financial year 18. Activity levels of the counter increased further, with TJL being added to the S&P SL20 index in December 2016. The financial year 23 earnings have been considered when arriving at the target price, as we believe financial year 22 will be a year of transition as the company will be enhancing their capacity by 25%, which should fully materialize in the first quarter of financial year 23. Therefore, we feel given the expansion, it is only fair to value the company based on financial year 23 earnings, which accurately represent the company performance going forward. Based on the above, target price for TJL is 50 rupees and 10 cents. With an upside of 21.6% based on financial year 23 earnings forecast. Strong earnings expectation, as well as the fact that 100% of the company's revenues are in foreign currency, provides investors with a natural hedge against rupee depreciation. As such, we expect increased investor appetite towards this counter. We expect a dividend payout of 68.38% in line with the 2-year historic average payout, resulting in a 6.45% dividend yield during financial year 22 and an attractive 7.72% in financial year 23. Over to you, Prashani, for the Q&A session.
We thank you, Hasita, Divya, and the analyst for the valuable insight on the Colombo stock market. Now, can Mr. Shehan Mendes, Assistant General Manager of Capital Trust Securities, will read out some of the questions which have been sent through the chat by the audience, please.
Thank you, Divya. Thank you, Hasita, for that very good presentations done on Expo and TJ. So, good afternoon, ladies and gentlemen. We welcome you for this second edition of export sector stock picks. As you may have, some of you all may have logged into our first edition also 2 weeks ago. And before I go into take up any questions, of course, you all can now type in any questions you all may have on TJ and Expo or any other export counters that you all wish to clarify. Before I go into any of those individual counters, I would like to just touch upon the idea behind having these export sector stock picks webinars. Hasita, Divya, would you like to maybe touch upon that? Why investors should focus on these export sector counters, and what is the importance of it right now especially in the backdrop of maybe we've seen articles saying the US dollar being quoted at very high prices like 220 plus levels. So what is the importance for an investor to look at these counters at this point in time?
Hi, Shan. Yeah, good question. So, okay, there are two folds we can look at it. First of all, these companies that are export oriented, their margins should be positively impacted given the LKR depreciation, because there are certain fixed costs which are in LKR, but the top majority of the top line is in USD. So when you look at an EBIT level, the EBIT margins should improve if the rupee depreciates. So that's one element where the net profit and net earnings should be positively impacted due to depreciation. And especially when you're talking about the rupee going to somewhere around 220, that's a significant boost to margins. Then, okay, the second element is on other comprehensive income. So most of these companies have dollar-based reserves in terms of cash balances, etc. So when the rupee depreciates by 10% or so on, that translation gain comes in terms of other comprehensive income, which goes into the balance sheet and as an increase in net assets. So there are two benefits. So that's the reason that we're quite bullish on the export sector, because we're expecting earnings to their margins to improve, as well as their other comprehensive income to gain as well. So that gives the opportunity for investors to protect themselves against the rupee depreciation and experience certain gains in terms of earnings multiples, as well as absolute earnings as well.
So there are a few questions we have got, and I'd like to first take up one question on Teejay Lanka. That is, we actually touched upon this topic when we covered Haley's MGT as well, but I would like to take up that question. It's about the impact of a possible GSP plus removal. So for the benefit of whoever is joining in for the first time for this webinar, would you, Divya, would you like to touch upon what is the impact you expect from GSP plus? And I would like if you can explain what GSP plus for the benefit of everyone who doesn't understand what GSP plus is, and the impact of that to Teejay Lanka if that is removed.
Sure. So essentially, it's a sort of a concession which makes your exports more competitive. So it gives you about a 12% edge. So that is why it is quite important actually for the Sri Lankan apparel sector. But when you look at companies like TJL, right? So they primarily work with strategic buyers and with sort of high-end fabrics. So their product portfolio is not really price driven. So that is why we mean that they are able to kind of withstand any challenges because their product portfolio is not price driven. Also, their product is primarily fabric. So GSP plus actually is more on the finished garment. So that is also another reason that we are not too worried about it. TJL in particular as well has an added advantage because they have sort of manufacturing facilities in multiple geographies. They have a footprint in Sri Lanka as well as India. So in the unlikely event that some GSP plus is not renewed, they have the ability of shifting orders between the two manufacturing plants, and thereby actually are in a better position to benefit from even FTAs in India. Because at the moment, there's a strong FTA even between India and Japan, which TJL is benefiting from. Similar trade concessions between India and EU, which TJL is benefiting from as well. So that fact that they are supplying non-price driven segment, high-end fabric, as well as the fact that they have this multiple geographical advantage, they are able to withstand it. Also, if you kind of trace back to the past, even in the past, despite a loss of GSP plus, their product mix didn't change. It largely remained the same. Their key export markets didn't change. That also remained the same, where EU still contributed about 50% even at that point. So it just shows their ability to withstand this kind of challenge and their resilience.
Right. Another aspect that I would like to touch upon is you spoke about them having sustainable products and maybe using biodegradable raw materials. What is the importance of focusing on those aspects? Maybe looking into the future, do they have a competitive advantage focusing on those aspects? What is your thoughts, Divya?
Definitely, Shehan. Actually, because I mean, the sort of the consumers are more aware, and the consumers' preferences are now more on to actually ethically sourced, sustainably sourced products. So even the retailers, the sort of the key strategic accounts that TJL supplies to, are very conscious of this. So it's almost like conscious consumerism. So TJL, I mean, being sort of innovation and sustainability being at the heart of the company and the core of its values, is very well positioned to actually take advantage of this consumer trend. Also, I just mentioned in the presentation that it is actually the first Sri Lankan fabric mill to get into this US cotton trade protocol program, which also kind of further cements and almost, gives them sort of an edge, as it is like a grading on the ability of them sourcing ethical cotton.
Right. I'd like to maybe take up a question on Expo. Now, a lot of investors still have the perception about Expo. Of course, they've experienced rapid growth over the last 1 year, and everyone believes that is owing to high freight rates, and that could be short term as the pandemic maybe tends to ease off. Their margins will erode and profitability can go down in the future. What are your thoughts on that, Hasita?
So Shehan, let me answer that. Let's take a step back and look at what happened last year, for example. In the first quarter after pandemic, Expo was quite dynamic in terms of actively pursuing PPE logistics. So there were various charters that were carried out, which added to their bottom line. And so initially people thought, okay, that was one-off, right? The earnings were sustainable. Then because of the pandemic capacity constraints, the rates were quite high last year. So everyone expected these rates to come off this year. And as I showed in the presentation, these rates haven't come off this year. And they're forecasted to continue for another 12 to 18 months as per management and industry sources, right? So FY22, these rates should maintain, but we are taking a view, okay, in the fourth quarter, there's a possibility these rates might come off, right, on a GP level, and the yields might come off. And FY23, we're being quite conservative again, we're assuming these yields come out considerably. So even though these yields come off on a GP basis, their volumes are growing at a really rapid pace, right? So we're looking at significant growth of 40% in FY22, if I'm not mistaken, and around 25% year-on-year growth in revenue next year. So although the GP margins come off due to the yields coming off, the absolute quantum of GP is not expected to come off because the volume growth is expected to compensate for the reduction in margins. Okay, so, and we're still at, so looking at Expo, where they stand in terms of key strategic accounts in the Far East and new markets. These volumes should only grow should grow exponentially in the coming years, right? So even if you normalize yields in terms of margins, GP margins in the future years, these sort of absolute PAT figures are sustainable in our opinion and not one-off. So that is something that the investor community needs to come to terms with and realize these absolute profitability figures are actually sustainable and not one-off. And the margin and the P's will ultimately reflect that in future years.
And Divya, coming back to Teejay Lanka, one of the key challenges that you mentioned was the possibility of the cost to get escalated. And how do you think Teejay is positioned to basically absorb such a risk? Are they able to maybe pass it on to the consumer, or are they able to better manage the cost escalations? What are your thoughts on that?
So in general, actually, there is a time lag associated with passing on a cost increase. So generally, even in the last quarter, I think when you saw an escalation in cotton prices, that is why the GP margins also has come off, because usually there's a 3 to sort of 4 month time lag in terms of passing it on. But saying that around 80% of their portfolio is for sort of mid and high end value-added fabrics. So for that, they are well positioned to pass on any cost escalations to the end client. But for the basic segment, there would be a proportion which they are unable to pass on. However, TJL has consistently also focused on operational efficiencies. So their operating margins are always healthy because they continuously upgrade their manufacturing outfits, and they're continually bettering the production. So their operating margins, we are very confident that they will be able to sustain and strengthen even operating margins, even though temporarily GP margins can take a small reduction, but it's very temporary because within that time lag, they are able to pass it on. It's just the time lag associated with the immediate increase in raw materials and them passing it on to the end client.
Yeah, there's a question on the fair value of 125 target price. Now, would like to know what is the minimum target price for Expo? What is your expectation?
Okay, it's a good question. So actually, what we want to do is actually come up with a very justifiable value for the share in compared to competitors as well as the local market. So giving a local market context as well. So looking at the 53% growth in earnings compared to what Rennie thought was one-off earnings last year, we're expecting profitability to grow to 22 billion, for example, right? So that, in essence, given the growth in earnings, results in it should be valued at a higher multiple, because the market in general is not growing at this 53% earnings on a year-on-year basis, for example. So some might say, okay, there's a justification that in terms of multiples, Expo should be trading at a higher multiple to the market, given the current operating environment and its exposure to foreign currency, etc. So we have been quite conservative in terms of the multiples, both in terms of key competitors as well as the local market context, right? So in the short term, it depends on market dynamics. The daily turnover levels, for example, as well as the investor's mindset. We feel, okay, the share should ultimately trade at this fair value once the market dynamics change and people actually come to a conclusion that these earnings are sustainable. But in the short term, we can't really allocate a target price as such, because that will depend on market dynamics. But the price should ultimately reach its goal, in our opinion, given the sustainability of earnings and the relatively conservative market multiple that we're using.
Actually, adding to that, Hasita, I just wanted to ask now, these forecasts, since we are talking about, even though we are talking about possible rupee depreciations, have you all factored in into your forecast the forex gains, that anticipated forex gains into these profits that you all have forecasted for FY 22 and 23?
So Shehan, the numbers that are quoting is 22 billion is actually net profit, excluding translation gains and other comprehensive income. So I think last year, the other comprehensive income was only 700 million, right? But this year, given the greater cash balance as well as the greater profitability, the translation gains should be much higher. And if you look at other comprehensive income, will be much higher this year. So we really haven't factored that into our multiples or our projections, right? So these translation gains are not included in our projections.
Yeah, just going back to some of these general questions that have come up. There's a question on will CBSL allow to free float US dollar to LKR 220 and above? What are your thoughts? Divya, Hasika, would you like to answer that also?
So again, I think we touched upon this sometime back in our previous webinar as well. We are of the view that the LKR will continuously depreciate this year given the current status in terms of reserves and money printing. So yes, we do expect the rupee to depreciate, but to the levels of 220 we are yet to see, but it all depends on the market dynamics going forward, when the markets will open up for tourism and we can start generating foreign currency, etc. So as well as import restrictions being lifted. So I don't see that happening, but hopefully in financial year 2023, tourism should pick up and start generating dollars. But in the interim, I'm expecting some volatility in the rupee, especially after the bond payments repayment is done on the 27th of July.
There's a question from Angelo Labroy. I'd like to take that question and refer it to Divya. It's about Nike and most premier brands are transitioning their product portfolio into recycled synthetics from cotton and special sustainable apparel that doesn't include cotton. Also, big brands such as Nike has already been accused of not having a sustainable strategy on cotton sourcing and lost face value by not considering the pesticides and herbicides. In this context, Teejay current product portfolio, will it have an impact?
Yeah. So, so Shehan, actually, like we just mentioned, from a sustainable angle, I think they have got various accreditations and continuously, focusing on sourcing sustainable and ethically sourced sort of raw materials. Other than that, also the new capacity additions and also some of the machinery upgrade, it consists of dual capable machines, which means that they can do both nylon as well as cotton. In that case, they won't really be too impacted because they can switch between the products given their machinery capabilities. So also, like we mentioned, synthetics is a growth segment even for Teejay, given the demand in the market, and they have the necessary expertise and the machinery in place to cater to it, and has also mentioned such that it is a growth segment and is an area that they will be focusing on.
Another question that I'd like to raise to Hasita is it fair to compare Expolanka with global giants like FedEx and other global giants in your presentation? What are your thoughts about that?
Okay, so there are two thought processes, right? So in terms of its operating capabilities and operating markets, they are actually a global MNC. They're in 29 countries. They're actually operating mainly to the US, where 75% of their volumes are US trade volumes, right? So they're competing with these global companies. So they're the closest peers. So we need to compare them. Okay, but at the same time, we have to take into consideration the market dynamics of the Colombo Stock Exchange as well, right? So that is one of the reasons that we're going with a 10.76 sort of multiple, which is linked to the broader market multiple and a discount to the global peers. But there can be a justification that the multiples should be much higher than what we have assumed. But given the upside and already the quite strong target at the fair value, we went with a relatively conservative market multiple.
There's another question from Angelo. It's about Teejay. What is the cotton and synthetic percentage-wise contribution to GP margins?
At the moment, from a revenue perspective, it's around 90% cotton and 10% synthetic. But like I mentioned, synthetic is a growth segment. They do have dual capable machines to actually, continue production of synthetics as well. So they can interchangeably use the machinery to produce both cotton as well as synthetic. But at present, it is 90-10.
There's another question on a general question I'd like to ask, given that we have given some fair valuations for these stocks and the future expectations. I know I might be putting you on the spot asking this question. Probably this might be better suited to ask from a fund manager, but from an analyst point of view, I'm just asking, very well knowing what is to pan out for these companies. I see a lot of retailers and surprisingly some other institutional investors also that we consider to be long term. But I see as soon as some of these counters appreciate in price, maybe even with a marginal increase like 5 to 10% marginal increase, I see we experience selling coming into the market. So from an analyst point of view, knowing what's to expect in these counters in future, do you think, what is your view on that? Do you think it's better to hold for the long term these counters with the growth prospects that you anticipate?
Yeah, it's a good question, Shahan. So we're of the view that it's important to identify value counters that's trading a significant discount to its fair value. Okay, in the long run, share prices should come close to its fair value for various counters. But obviously the investor mindset as well as patience and market dynamics have to change. When a counter is trading at a 50% discount or 55% discount to its fair value, investors shouldn't really look at it as a trading count as such, right? If you hold it in long term, it should definitely outperform the broader market as well as most of the shares, other shares in the market, going on that basis. And considering that we have been quite conservative in terms of future projections as well as associated multiples, there's a good chance that Expo will outperform most counters once investors come to terms that these earnings are actually sustainable.
Yeah, just to add to that as well, Shahan, I mean, completely agree with what Hasita was saying there, because our analysis is actually based on looking at the sort of the forecasted earnings, the operating environment, and it's based on like a fundamental analysis. So we actually see a lot of value in these counters that we have presented. So our view is not really on a short-term basis as such, but again, it depends on each investor's, sort of preference and their trading styles and their trading strategies, really. But if you do hold these counters, like Hasita mentioned, over a period of time, it should reach its fair value.
Yeah, there's a question on the comparing Expo to the global peers. This question is basically asking, when some of these global peers are trading at very high PE ratios, why Expo is trading at a very low PE. Is it justifiable? I think you touched upon this topic. Would you like to explain a little bit on that again?
So as I mentioned before, what's happening is as I mentioned before, Shehan, what's happening is yes, there is a thought process saying that that Expo should be valued in line with global peers. That's actually methodology used by various foreign institutional funds when they enter Sri Lanka. If you look at some of the MNCs are trading at these high multiples compared to other global markets, which are in line, right? So, but at the moment with the investor activity being majority is being local retail investors as well as local institutions. The mindset is a bit different. For example, local institutions need to book profits to pay dividends to the stakeholders, for example, from SLIC to various other institutions. So what they do is when certain shares are in the black, they actually realize certain gains. And the same way, local retailers, they usually sell shares in the black and keep shares that are in red, although they might be overvalued or underperforming. So I think this mindset needs to change to a certain extent, where both the local investors as well as the retailers need to be more prudent in terms of managing their portfolios, similar to what happens globally and global fund managers.
That's a very important aspect you spoke about, Hasita, that we've been experiencing in our Colombo Stock Exchange. And I can remember at our last webinar also, we basically one point that was brought up was what else are we going to invest if we sell some of these very good counters? What are we going to move into? Are there better counters to move into? So it's a very important aspect that our investors have to keep in mind.
Exactly.
Coming back to another question, what is the percentage of the value of imported raw materials to the revenue? Could they get affected from a rupee depreciation by increasing the cost side? Right. I think the major concern is from an importer's point of view, because I believe this is targeting Teejay. Since they have raw material imports, will they be negatively affected in an environment like this?
Yeah, so Shehan, approximately 60 to 65% raw materials are imported. But the thing is, because they are a foreign income earner, so they earn in foreign currencies, so they can actually use that to settle the import bills as well. So we don't see them being impacted in this scenario. Because they have receivables and sufficient receivables, as the component of imports only account about 65% of the total cost of sales. So because of that, they have sufficient receivables where they can use that foreign currency and settle the import bills without disrupting their operations.
I think when it comes to Expo, I think they have an added advantage since they are not a importer, even though they earn in dollars. Isn't it, Hasita?
Yeah, so basically, anyway, Sri Lanka only accounts for around 7% of their revenue at the moment, and that's decreasing even further as the foreign operations grow. So I don't think they're really exposed to, again, this shortage of dollars in the market as such, and there's no real requirement in terms of importing raw materials as such, but they need to make payments to various suppliers and freight lines, etc. So basically, that will this shortfall in dollars in the current market won't really affect Expo.
I see a lot of questions coming on Expo. I'll take another one on Expo. Please explain why EXPO'S cash flow position is poor compared to significant revenue growth.
Okay, so as I touched upon the key strategic buyers and customers of EXPO, right? They are mainly MNCs based all over in different geographies in the Far East as well as the US. So basically, they provide long credit periods to these customers, maybe 3 months, etc. But since they have the backing of SG Holdings, since basically they have access to cheap funding back from its SG Holdings, they can really afford to provide this longer credit terms to their customers and generate this revenue, and not really have an impact on their bottom line and margins, right? In terms of historically what has happened, they so far haven't experienced any write-offs because the clients they deal with have very high credit grades and haven't defaulted. So they're going on that basis and they can afford to provide these credit terms, which obviously negatively impacts their cash flow position to a certain extent. But since they have cheap cost of finance, they can afford to do that.
Right. So we are coming to towards the end of our Q&A session. But before I conclude the session, I'd like to, we've been discussing about this point even during this session also. We'd like to share some of the recommendations that Capital Trust have made through the research reports. As you can see, returns include year-to-date returns. You can see how the performance of some of these counters that we have covered. And one important aspect that you have to look at is the total return includes not only the dividend return, but also capital gains. So in order to make capital gains, one should hold on to their share rather than try to buy and sell at different points. Of course, if you're lucky, you might be able to catch the swing properly, but if not, you might miss it entirely. So it's important if you invest in a stock for the long term and hold on to these stocks where you can enjoy the full return from these counters. So this is an important message that as a company that we want to put across to our clients. So something that you all also can keep in mind in future when we are recommending stocks, when you're buying stocks, something to keep in mind. So with that, we would like to conclude today's session. I would like to thank all the investors for joining for this webinar. And thank you, Hasita, Divya, for your very insightful comments, advices. So with that, we would like to conclude this session. Thank you very much. Over to you, Prashant.
Thank you so much. So if there are no further questions, I would now like to close the webinar. On behalf of Capital Trust Research Private Limited, I wish to extend a sincere thank you for our staff for organizing this webinar and for valued clients for their participation. Hope to see you soon at our next webinar. Have a nice day.